Welcome to Accounting in Focus. Hello, today we're going to talk about the basics of the cash flow statement. We're going to talk about why we do a cash flow statement, the section of the cash flow statement, and how changes in our financial statements affect the cash flow statement. The reason that we do a cash flow statement, and in this entire discussion we're going to be talking about the indirect cash flow statement. The reason that we do one is because there are differences between net income and our change in cash. So what happens a lot of times when I'm talking to clients is my client will say, well, hey, my net income on my income statement was $100,000. Why wasn't my change in cash $100,000? These items do not equal. So what we're trying to do with the cash flow statement is we're trying to answer that question. Why is my net income one number and my change in cash a different number? Now, what we find a lot of times on the cash flow statement is there are changes in different balance sheet accounts that affect our change in cash. So, for example, think about accounts receivable. What is accounts receivable? Accounts receivable are sales that we made to customers that we have not gotten paid for yet. So, what happens when we book an accounts receivable? Well, we book the sale, right, and that makes my net income change, but my cash doesn't go up. So that accounts receivable is one of the differences between my net income and my change in cash. So we're going to look at changes in the balances from the beginning of the year to the end of the year on the balance sheet, and we're also going to look at items on our income statement that are considered non-cash items. And we do have a few of those items on our income statement. So before we start looking at the individual accounts and where they would show up, let's talk about the three sections. We have three sections on our income statement. They are operating, investing, and financing. Now, the way I remember this is I remember OIF. Okay, that spells OIF. And OIF is the sound that students make when you ask them to do a cash flow statement on an exam. They go, oh, Professor Ingram, OIF! Okay, so that's an easy way to remember which order they go in on the cash flow statement. So in the operating section has things that affect operations. Okay, so the way that I like to think about this is I like to think that these are accounts that directly tie back to my income statement. So, for example, okay, we talked about non-cash items, right? Non-cash items are things like depreciation, amortization. Okay, depreciation is a non-cash item. Think about it. When you record depreciation, what are you doing? You're accounting for the depreciation expense, but your offset to that is not a cash account. It's accumulated depreciation. So there's no cash, okay? Another non-cash transaction, gains and losses. Okay. The way I think about gains and losses, if you own a stock and the value goes up on the stock market, you have a gain. However, unless you cash in that stock, you're not getting any cash for it, right? All we're saying is that the value of the asset increased, which generates a temporary gain. So gains and losses are non-cash transactions. The other types of accounts that go into operating are items that affect your income statement. So for example, we started off by talking about accounts receivable. Accounts receivable is a does not affect our cash, but affects our net income. So the way that I look at this is that current assets, things like accounts receivable, inventory, prepaid items, okay, all those items affect our operations. They either affect income or expenses. Also, you have to put in here current liabilities. Think about things like accounts payable, salaries payable, taxes payable, interest payable, right? They all have expense accounts that they are linked to. So if you want to think about it from that perspective, that think about if we buy materials and we put them in accounts payable, okay, or we buy inventory that we put in accounts payable, we could put utilities in accounts payable, right? All of those items will eventually show up in our net income, but they don't affect our cash. Okay, so we're writing off expenses, but no cash went out. Okay, so current liabilities also go in operating. If you're not sure what your current assets and your current liabilities are, you may want to go back and review that, because that's going to be really important when you're doing the cash flow statement. If you can't identify those accounts, then you're going to have trouble determining where things go. Now, the investing section. Ask yourself, what do businesses invest in? Okay, businesses invest in things like property, buildings, machinery, and we can also invest in other companies. So sometimes companies will buy and sell the stock in other companies. Okay, so you can buy other companies either through stock or by buying the assets of the company, but that's considered investing. Okay. Now financing, the way I think about financing is how do we pay for it? Okay, so if we're going to buy property, buildings, machinery, other companies, if we're going to pay for operations, how do we pay for those things if we don't use cash? Okay, so there's a couple different ways we can do that. We can take out loans. Okay, we can sell our own stock. Okay, so this is going to be our stock, not stock in other companies. So you need to be thinking about equity. Okay, so things having to do with loans and stock go into financing. Now, the other thing that goes in here, which pertains to stock, is if we pay dividends. Okay, these are only dividends that we pay. Okay, so we'll put that in there. Paid. Okay, now think about it. Why doesn't interest go in here? Well, interest on loans is something that shows up in our net income, right? We deduct that to reach our net income. Dividends, however, do not go on the income statement. They go on the statement of retained earnings. So therefore, that's why dividends paid goes under financing, but interest does not. Okay, so those are some basics of the cash flow statement and what goes into each section. Now, the last piece is, how do you determine whether to add something or subtract something on the income statement? What we're always looking for on the cash flow statement is we are looking for changes. Okay, so I'm looking at how are my numbers changing. So let's get some more space here. Okay, so now what I want to look at, say we're looking at something like accounts receivable, and my prior year balance was $5,000 and my current year balance is $10,000. So what does that tell me? Okay, so the balance increased $5,000. Now, here's the way I think about this. Okay, this is my baseline, this $5,000. So at the beginning of the year, my customers owed me $5,000. I sold them my product throughout the course of the year. Okay, and at the end of the year, not only did my balance, it's not the same, it actually went up, which means that some of my customers did not pay me for the sales from this year. So if I have sales that are included in my income statement, but I don't have the cash for it yet, that makes my cash go down by $5,000. Okay, the other way that you can look at this too, accounts receivable is an asset. What happens when an asset account increases? Well, if I paid cash for it, then my cash went down. So anytime an asset increases, my cash decreases. The same thing, if my asset goes down, my cash goes up. Okay, so if you want to think of all assets in terms of, okay, what would happen if I sold a piece of equipment? Well, if I sold a piece of equipment, my asset would go down, my cash would go up. Okay, so that works for all assets. Now, let's look at accounts payable, which is a liability. My prior year balance was $5,000 and my current year balance was $10,000. What happened? That means that we purchased items, okay, over the course of the year, and I didn't pay off my balance. I actually let my balance go up. So my balance increased by $5,000. Okay, so what happened here? If my balance goes up in accounts payable, it means I used other people's money to pay my bills. Now I wrote those bills off on my income statement. So I have expenses on my income statement that I have not paid for yet. So what does that do? That actually benefits my cash balance. My cash balance is actually $5,000 higher than we think it would be. Okay, so anytime you have a liability, ask yourself, what happens if I went to the bank and took out a loan? Okay, and say we took out a loan for cash. My liability goes up. What happens to my cash? Well, if I take out a loan, that means the bank's giving me money. My cash goes up. Okay, so when a liability increases, your cash increases. When a liability decreases, your cash also decreases. Okay, so when you're doing a cash flow statement, you need to look at the changes in the balances, what's happening, and then how does that change affect your cash? So the question I always ask myself is, who has the money? Do I have the money or does somebody else have it? Okay, so in the case of accounts receivable, right, I don't have the money. My clients have it, right, because they haven't paid me yet. So that makes my cash go down. With accounts payable, if I don't pay my bills, right, I've got the money and I can use it for other things. So if I've got the money and I can use it for other things, that effectively makes my cash go up. And when you're dealing with, this is mostly for the operating section, because a lot of people have trouble with things like accounts receivable and accounts payable. But when you're dealing with the other sections, investing and financing, just ask yourself, would money be coming in or would money be going out? If we sell stock in our own company, what happens? My equity account goes up. And what do I get in exchange for giving that stock? I get cash. So my cash goes up. Okay, so all assets act the same way, all liabilities act the same way, and all equity acts the same way.